Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today, we'll explore to effectively use Creditor Tools, specifically global cash flow. NACARA aims to bridge the gap between debtor and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Global cash flow analysis. The primary repayment source for most loans are the cash flows generated from the debtor's business operation over time. The secondary source of repayment is generally the collateral that secures the loan. The third or tertiary source of repayment is often the guarantors, be they individuals or other affiliate entities or both. Over time, the guarantors may or may not add additional cash flow or collateral support. The collateral aside, unless it is income-producing commercial real estate, one way to determine the global financial support beyond the primary cash flow source is to conduct a global cash flow analysis of all cash flow sources and all debt service requirements. This global cash flow analysis will include all direct obligors of all related loans and all the guarantors pertaining to those loans, be they individuals or other legal entities as guarantors. The result will be a consolidated global cash flow analysis and debt service for the legal entity debtor and any and all guarantors and those related to the account debtor. When all global cash flows and debt service are analyzed together, this will confirm the overall repayment ability in each consolidated loan relationship, if you would. A global debt service coverage ratio will be determined, together with a trend analysis from prior financial statement reporting periods. So you can see the trend. Is it getting stronger? Is the margin getting stronger? Is the ratio increasing or is it decreasing? The coverage trend will either be stable, improving, or declining. Determine the reasons for those changes and whether they are systemic and how soon any issues can be resolved. You see, creditors want to see the big picture. The purpose of the global cash flow analysis is to determine the overall direct and indirect repayment capacity of the given loans in a credit and deposit relationship. It considers all cash flows from all borrowers, legal entities, and their guarantors. Even when a given loan begins to deteriorate, the creditor will seek to understand the entire cash flow picture, those expected cash flow sources which would be available to support repayment of the problem loan if needed. Indeed, the creditor may have legal recourse to enforce repayment of all such obligated parties. The credit analyst will need to also dig for potential contingent liabilities too, like co-signed debt or general partnership debts that the individual guarantor or legal entity guarantor may be liable for. Therefore, it would be necessary to obtain tax returns and their supporting schedules to identify all cash flow sources as well as any required and discretionary cash outflows from all activities. This includes the IRS profit and loss forms for businesses and properties for obligated individuals and legal entities, as well as IRS Form K1 or K1s that show distributions and contributions to individual guarantors. So how do you get to a global cash flow coverage ratio? Generally speaking, the debt service coverage ratio can be determined by starting with the net profit or loss, adding interest and dividends, capital gains or losses, cash flow from rental properties, partnerships, and S-corps, adding depreciation expense and interest expense to get the cash available for debt service. Then subtract federal and state taxes, FICA, other deductions, and reasonable annual living expenses to arrive at the net cash flow that's available for them to service the debt. The underlying debt service payment requirements are totaled and then subtracted from the available net cash for debt service. And this determines the debt repayment margin. and then divide the cash available for debt service by the debt service requirement, and then you'll be able to find out what the debt service coverage ratio is on a global basis. Each one of the related entities owned by the obligors and guarantors of the subject loans in the relationship will have their assets, liabilities, and cash flows analyzed, and the cash flows will be consolidated into one global cash flow analysis and a global debt service coverage ratio. In a global cash flow analysis, the result will be all the multiple sources of combined cash flow to determine the global cash available to service the global debt. And once that's determined, you'll see a global debt repayment margin, the difference between the cash and then the debt service, the net cash available for repayment, and then subtract out the actual debt service, and you have the margin. Either there's a surplus or a deficiency. And of course, you can easily calculate the global debt service coverage ratio. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at thetunabudget.com to tune in to the Debt Service Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay tuned, stay informed, and be ready for whatever comes next. So why is the global cash flow analysis important to you? First, construct a bridge across any so-called Grand Canyon that may exist between the parties, between you and the creditors. For several good reasons, creditors may have a hard time getting sufficient documentation from you so they can perform an accurate global cash flow analysis. It will likely not be because they don't understand how to do the analysis. The primary reason will likely be because you have not submitted sufficient financial information. And why might that be? Maybe it's due to the lack of mutual respect and trust between you and the creditor. Something's gone wrong. These stressed relationships mean less transparency, but it doesn't have to be that way. Fast forward, okay? Is it incumbent on you to step up and take the lead in finding, preparing, and presenting your best efforts repayment solutions to your creditors? Maybe you should ask the creditor for a copy of its global cash flow analysis for your credit relationship. Follow through until you get a copy. Open the lanes of communication and restore them if needed. Construct a bridge across any so-called Grand Canyon that exists between the parties, especially during stressed economic times. There needs to be, and in fact will be, a paradigm shift that empowers debtors to own up to figuring out their own repayment solutions on a best efforts basis. Creditors are expected to be prudent in their lending and workout deals that are in everybody's best interest. So there is space and room for you to be forthcoming with the creditor and provide all the necessary current, accurate, and complete financial statements, your own pro forma cash flow statements, and copies of federal tax returns, and personal federal tax returns too. Let the creditor perform a global cash flow analysis and share the results with you. Get their agreement. It's your season to be forthcoming. Next, a cooperative workout situation is best. Hopefully you appreciate how a solid global cash flow statement can be used to come up with a viable repayment plan. All the obligated sources of cash flow are on the hook anyway. Should the creditor need to pursue a forced global liquidation and recovery solution? And if you are honest and willing to abide by the loan documents you promised to follow, you will happily accept the documented financial reporting you're required to submit to the creditor. So partner up and give all the required financial information on or before the requested date. And be sure each is signed and dated by you, the owner. Ask to see the creditor's financial analysis. Sit down with him and ask him to walk you through it with you and answer his questions. At the end of the day, wouldn't it be nice to be on the same page and have a mutual understanding of the resources that are subject to getting the loan repaid? And you have your own proposal for utilizing your cash flow as best you see fit, because you want to repay. You want to cooperate. You need the creditor's help to do a loan modification or a forbearance, etc. And if you think and know your repayment ability is weak at best, that's okay. It is what it is, right? So communicate that, because why? It's your very best efforts. You and your creditor want to see and understand together your global cash flow picture and overall ability to repay. Surely you will have a greater sense of peace of mind, not to mention the wherewithal to negotiate the best deal you might recommend. Creditors can be tough, but they are also reasonable people with well-supported and documented global repayment solutions that come from a well-prepared debtor. Thank you for joining us. Today we covered the Creditor Tool Global Cash Flow as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, your questions, inputs, recommendations with us at ncara or nicara.org. If you found today's episode helpful, please subscribe for future notifications and podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.